Welcome to Construction Champions Podcast, where we are burning the house down and rebuilding it twice a week. I'm your host, Nussbaum, and I am here to help you become the champion that you're meant to be. Along with our amazing guests along the way, we will provide you with the resources, the latest and greatest. You will sit down with disruptors in the construction industry. And my goal from day one has always been to change the mindset around the construction industry. No more where we let the 3%. Welcome back, Construction Champions, to another episode. I'm your conversation facilitator, Ron Nussbaum, and I'm the one that has the great privilege of getting people together to have conversations on how we can be better in the construction industry and in our life and business and relationship. Anything, you name it, we bring it on here. We have conversations about it so we can all go be the champions that we're meant to be. Like I said, it's not just Ron Nussbaum rambling for 30, 40 minutes. We bring on amazing guests and have them give you tidbits that you can go apply today to your life, your business, everything in between. And to get today is no different. Gerri, it is great to have you here today.
Thank you for having me.
Well, before we dive into it, why don't you introduce yourself to all the construction champions out there listening?
I'm delighted to. I've been in the credit field for, a few decades now, back before we had free credit reports. So, and I really enjoy trying to dive in and help individuals and small business owners navigate credit because, it's something that impacts our lives in a lot of ways, but you don't learn it in school. If you do learn it, it's probably the school of hard knocks, and you'd rather learn, you'd rather have it turn out to be something that's helping you rather than something that's hindering you. So it's a lot of fun.
I love it. And it's definitely something that is very confusing and misunderstood most of the time.
Yeah, and there's been such a change. Is when I started in this industry, no one knew what FICO scores were. I'd talk to consumers and have you checked your FICO score? They deer in the headlights look, right? Well, now it's still the same thing with business credit, which I know we're going to talk about today. And business credit has actually been around longer than consumer credit. So it's so interesting that so many business owners have these business credit files that they don't even know could be impacting their businesses. So hopefully we can dive into transparency and also understanding how to leverage those.
Oh, we will absolutely be diving into that. I think you're one of the first experts we've ever had in this field, and it's a very important field. So I'm super excited for our conversation. And I'm just going to dive in there and ask the $1,000,000 question. And that is, what makes a construction champion?
I think a construction champion, at least from my perspective, I'm going to go back to that old adage of putting the mask on for the oxygen before, in the case of an emergency. Someone who is financially resilient themselves, because this industry does have a lot of ups and downs. There are a lot of cash flow issues that you'll encounter, and we've all heard stories of businesses that didn't make it, and perhaps even brought down clients with them, because of their financial missteps. So if your business is financially healthy, it's a lot easier to serve your clients in the way that you want to and to be in business for the long term.
I love that. And it's a lot less stressful.
Absolutely. Absolutely.
Also, well, I want to dive in to the credit thing, especially like you had brought up the business credit, because there's probably a lot of people out there that have everything in their personal names. They don't understand this is even a thing. And if they understand it's a thing, a lot of people do not know where to even get started. So could you kind of just break down business credit versus personal credit and just give people some clarity on why they should be looking at this differently?
Yeah, absolutely. So similar to personal credit, where we have the three major consumer credit agencies, Equifax, Experian, and TransUnion. On the business credit side, the three major agencies are also Equifax and Experian, and Dun and Bradstreet. And Equifax and Experian have both consumer and business credit divisions, but those data sets are completely separate. So they never mix the two. They're like separate business divisions, right? So it's like your residential and your commercial business. There's similarities, but they're their own business. And what's interesting for many business owners is that they may have a business credit report and not know it. So it's entirely possible that if you have some sort of, let's say you have a business credit card with even one of the, big box firms like Lowe's or Home Depot or someone, or you have some kind of supplier credit with one of your suppliers, it that information may be reported to business credit and you don't know it. There's no laws like there is on the consumer side that give us free credit reports, and now you have Credit Karma and all these companies that give you free credit scores. That does not exist on the business credit side to the extent it does on personal, because there's no regulation. And so what happens is either one of two scenarios. Either, the business owner is listening to something like this and says, oh, I need to go check out if I have a business credit report. Or more likely, something happens where they don't get approved for something that they want, and it's based on business credit. And then they find out that there's this report. So I'll give you a quick example, Ron. I did a webinar for accountants, and one of the participants reached out to me afterwards. She said, I worked in the supplier department at one of the biggest box retailers in the country. You would recognize them. And she said, every supplier for a company would have to have a Dun and Bradstreet credit check. And most of them had no clue. Like they didn't know what it was about at all. So there's ways it can be used, and you may not be aware of it. And so I do want business owners to at least be aware of it. And then we can also touch on the proactive way to help protect your business as well a little bit later. So
Yeah, can you touch base on the Duns number and why that is important for them to have that?
yes, yes. So Dun& Bradstreet is one of the oldest credit bureaus in the United States. Fun fact, Abraham Lincoln worked as a credit reporter back in the day. There were actually 5 former U.S. presidents who worked for Dun& Bradstreet as reporters. And the DUNS number is their identifier in the system. So in consumer credit, you often think of your Social Security number as your identifier, which it, kind of de facto is, right? On the business credit side, each of the 3 credit bureaus assigns its own number to your business. And in the case of Dun& Bradstreet, it's a DUNS number. Now, it used to be that for a long, long time that a DUNS number was required for any government contracts. So if you were doing any kind of government contracting, you had to get a DUNS number in order to apply or even get into the system. Now, they've changed that in recent years to their own unique identifier. So it's no longer a DUNS number, but it still is something that is used largely in the industry, or it's used widely in the industry because of that history. And so, for example, if you were to go out and let's say, I don't know, set up a supplier account with your local, paint supplier, then you probably would be asked for your DUNS number on the credit application. It's just become sort of ubiquitous as an identifier for small businesses, but it is unique to that one credit bureau.
So I guess I might be jumping ahead, but so if they all have different numbers and you have those and you're filling out some kind, do you put all of that information on there, or how exactly does that work when there's not one unified number for your credit history as a business?
Yes, that's an excellent question. So typically, a lot of business credit applications, and again, we're talking about not just loans, but also lines of credit, supplier relationships, vendors, things like that. They often will ask for both a DUNS number and your employer identification number. Now, the EIN is not necessarily as ubiquitous as social security numbers are for consumer credit, but it is something that is often collected and used as another way to make sure that your business gets matched to the right information in the credit database. And you have to think about it from the standpoint that, there are millions of small businesses, and it's very easy in America to start a small business. I mean, that's great. It's super easy. However, what happens is, you got business owners who don't check business names, right? They don't find out that there's another business in the, same state that operates under the same business name, or maybe even another business that has a trademark name. That's another story, but they don't check. And so I think I talk about it this way. I was in an office with a small business development center advisor, and we just pulled up a local Chinese restaurant that was right down the street from this. And I think the name was something like China Garden. And there was like 6 different China Garden restaurants in this one metropolitan area. And they were not related. It wasn't a chain, right? It was just a popular name. And so the credit bureaus have to make sure that when they get information about your business, they match it to your business and not somebody else's. And so they use, your address and your phone number and other types of information, but the DUNS number and the EIN can be additional ways to make sure your credit file gets associated with your business and not somebody else's. And this is one of the things that we have seen when someone goes in there and checks their credit. And these are 2 common scenarios. One is they don't have business credit because they just haven't been doing any kind of financial relationships with companies that report to business credit. But then they also may find that their information is mixed up with another business with a similar name. And so when that happens, it can associate your business with something negative. And that happened to NAV's co-founder, Levi King. He had a sign manufacturing business, and he bought the assets from another business that went out of business. And the credit bureau mistakenly made it look like he had acquired the whole business and put that credit history into his, and that business had gone out of business for a reason. It had been neglected. So the credit history was not good. He lost out on a very big bid for a job as the result of that, and it took a lot of digging to uncover the real reason why. So these are the kinds of things that can happen if you're not aware of it and you aren't at least checking to make sure that everything is on the up and up.
Oh, yeah. So you could have issues that don't even pertain to you that could be roadblocks down the road unless you're proactively getting those fixed.
Correct.
I had never thought about that from a business perspective. I know a lot of our listeners are probably asking, they're saying to themselves, I have heard this is really like business credit is super, super hard. I always say that because I've seen it in all the construction groups on Facebook. People are asking questions where they're just like, I do not understand this and I cannot figure it out. Why, I guess, is it? And if like, why is that the perception of it?
Yeah, it can be confusing. It doesn't have to be difficult, but I think I think the biggest problem, arises from the fact that it's not regulated and there's just lots of different approaches to business credit, right? So you could, for example, set up with that account with that supplier, and if they report, maybe they just report to Experian, but they don't report to Dun& Bradstreet, or maybe they don't report at all, or maybe they only report if you don't pay on time. So unlike consumer credit, where it's pretty straightforward, you go out and get a car loan, mortgage, credit card, auto loan, it's going to show up on all 3 credit reports, right? So I need to pay it on time. I need to keep my debt in check. With business credit, the reporting is just not as consistent. And so that's one issue. The other issue, and this is a big one that NAV has been trying to solve, is that it's typically expensive to get your business credit reports. I mean, we're so used to free credit reports on the consumer side, but business credit reports, you can go out and pay upward of $100 just to get a credit report. So, and that could be on you or, another business that you're going to do business with. So that's something to keep in mind. And then there isn't the same level of transparency. So here's how to make it simple. Here's the simple steps. The simple steps are get accounts with companies that report to business credit bureaus and then pay on time. Now, again, not every account is going to report, not every account is going to be used all the time, but there are some sort of standard ones that are really common. For example, you probably, if you've been in those forums, you've seen Uline mentioned or Granger mentioned. Both of those offer a lot of industrial and janitorial and other supplies that construction firms can use. Those kinds of accounts, and then those are just net 30 accounts. You have 30 days to pay on time, and you're building a trade line. Another suggestion I have, if you have decent personal credit, is to get a business credit card, because most business credit cards report to at least one of the major bureaus. So there you can get your information, get that trade line established. That can be helpful. NAV has NAV Prime, which also submits as a trade line to the major credit bureaus. So there are a variety of different ways to approach this and get some accounts reporting. And if you get to that stage, you're ahead of a lot of other business owners. There's a lot of business owners haven't done that. So you've already kind of set yourself up ahead. But I also want to talk about why it's important, because I think because we don't get the same notifications necessarily if we're turned down for something based on business credit, like we do personal credit. I once didn't get the biggest discount on my homeowner's insurance, and they told me it's because of your credit, right? So they have to tell us a lot when it comes to consumer credit. They don't necessarily have to have business credit, and so people don't always realize. So these are the big ones that I would say. One is, you had that great episode with Gerri. I'm sorry, Gerri with surety bonds.
Yeah.
Yep, yeah. That was a great episode about surety bonds, and some surety bond companies will check business credit, so it could be an advantage. They can also check personal credit, as he mentioned, and so personal credit is also important. I will not downplay that; like it's important. Many supplier and vendor relationships, many of your traditional, like SBA, many bank loans, they'll check business credit, lines of credit, things like that, that a lot of business owners may rely on. And some companies will check business credit, some check personal credit, some check both. But you don't know, right? So if you don't know, and you don't know that the information on there is not helping your business, then you may not know that you didn't get the business because of what it said. So like that big box retailer I talked about, let's say you wanted to do some work for them. I don't know, maybe they needed to build out some, I don't know, some kind of landscaping function or something where they needed some construction help, or put in new flooring, right? They need to put in new flooring. So they need to hire a construction firm to do that. They will probably check business credit. And it may not just be to see what your credit score is, but it may be just to judge the capability of your business. So as you move into bigger jobs, especially commercial jobs and some government contracts, they're looking for capability, and they want to make sure that your business looks like it's financially stable and able to take on these bigger jobs. So surety bonds are one part of that equation. Your business credit could be another part of the equation, because the last thing they want is to have to go find somebody else to finish the job that you weren't able to, keep up with. So that's why it's important. It can also play into your insurance premiums. A lot of commercial insurance does check business credit, and some of the opportunities, if you want to partner, like I told you Levi's example, he was trying to do a big sign build out for a car dealership where it would have been multiple dealerships. It was a big job for him, and he didn't get it because of that negative information in his business credit report that he didn't even know was in there.
That it does, because we think about how it affects our personal life, but it can negatively affect our business as well without us even really knowing. And you brought up the different regulations and stuff multiple times. The difference is that something that is like possibly going to be changing in the business world, or is that just pretty much how it's going to be?
I don't know. That's a good question. There was some legislation proposed a few years ago. It didn't go too far. What we have seen recently in the past few years is a number of states have started to require business lending or business loans to disclose an annual percentage rate or APR. So when you go shopping for a mortgage or a car loan or whatever, right, you see an APR. That has not been the case traditionally in business lending. And so you had some cases where some lenders were using some really creative ways to describe their pricing that when you translate it to an APR, I mean, I'll give you one quick example. There was a story in Forbes about a woman who's going to buy the hair salon she was working in, and she got a financing proposal sheet, and it said something like 15% stated percentage rate or something. And so she thought 15%, this is great. And it was when that financing was put into APR calculation, it was over 1,000% APR. Over 1,000%. That could sink a new business very quickly. So several states have initiated or have passed legislation that requires an APR for most types of business financing. So that's positive. But the general consensus has been that that business owners are sophisticated and they should hire advisors to walk them through everything. And that's fine if you're a multi-employee construction company, but you're starting out, you probably have a tight budget. You probably are trying to watch every penny, right? And you may not have the background to figure out what you don't know and figure out how to make sure that your business isn't taken advantage of.
Mm. Yeah, it can be a real dog eat dog word out there. I keep thinking, so why we're talking about all of this is something that I hear thrown around all the time when it comes to this kind of stuff is a personal guarantee.
Mhm.
And I'm sure we have listeners that are involved in personal guarantees or they've heard that. And can you kind of walk them through that? And what are your thoughts on the personal guarantee aspect?
Yeah, sure. And just to note, I'm not an attorney or accountant or financial advisor, so I can't give you legal advice. But a personal guarantee essentially says if my business doesn't pay back this loan, you can come after me personally. So that could mean that in the future, if your business fails, you could be sued for the debt, and then whatever remedies are available in your state they could pursue, which could go all the way to, a judgment that freezes your bank account. So it depends on the state and the type of debt, and other factors. So it's something serious. Like a personal guarantee is something to really keep in mind and to be cognizant of. And many lenders like to get personal guarantees. For example, I mentioned SBA loans. These are loans guaranteed by the Small Business Administration. They can be great loans, but they do require personal guarantee. So you're on the hook if your business does not repay the debt. And the reason that is because if your business doesn't repay the debt, the lender can collect on the guarantee, and that's taxpayer money. And so they're going to try to collect from you so taxpayers don't pay back, essentially cover that loan. So if your business is in the first few years, personal guarantees are going to be very, very common. I mean, that's just the way it is. And if your business remains pretty small, personal guarantees are going to be very common. If you do not form an LLC or corporation, which I personally would be very cautious about as a construction business, I think that's really important to have that business structure. Uh, then you always are essentially providing a personal guarantee because there's no legal separation. It's you are the business. It doesn't matter if you register the business, it doesn't matter if you get a business license, it doesn't matter if you get whatever. You are the business. There's no legal separation, at least with an LLC or a corporation. There's a legal separation. So expect that, but as your business grows, then that's when you have the opportunity to build business credit and move away from personal guarantees so that you can more and more be able to rely on the business and the business financials. Again, this is just exactly what, the conversation about surety bonds was about, right? That as your business grows, you move up to those bigger contracts, you are able to, you need to rely on financial information about the business less than your own personal credit, your personal history, and your personal guarantee.
Yeah. And, I'm the same thing. I'm not a legal advisor by any means, But what like when I think of personal guarantees, I like early on, you're probably not going to have a lot of options. But it to me, it's like you are breaking that corporate shield of what an LLC or a corporation provides because you're then taking that risk and putting it right on top of you. We don't think about the risks until it's bad. We don't
Yeah.
ever like weigh the option, like what exactly. Sometimes it might not necessarily be worth it. Uh, because a lot of times when you have to do it, so you might be moving too fast. Like you might be moving into a project or something that you're not even at capacity to be able to do. And you want to make sure it's like as you grow the business, it is growing in a way where things aren't going to go south. We got enough variables in construction alone, let alone adding in financial variables that leave us access to a lot of risk, I guess would be the best way to put it, if we can't follow through. And if we're trying to move too fast or trying to do the biggest project we've ever done, and we're deciding that we're just going to take on not just the risk of the project, is I'm also going to take on all this personal risk as well. I mean, it starts to set up. You can only have so many things that are teeter-tottering before something falls down.
Yeah, yeah, absolutely. And another thing I don't get to emphasize as much as I like to, but think about it too. How can you use business credit? Because chances are you're not getting paid in full for that job before you complete it, right? So you're putting something into that job. Hopefully you're getting deposits and you have other ways to protect yourself. But you're putting in labor, probably some materials. There's a lot you put into that job before it's finished. So what are you doing? You're lending to that client. I mean, it is basically a loan to that client because you're saying, I'm going to do this before I get paid for it. And that's essentially a loan. And you can check business credit. So you're not going to be able to check your client's personal credit. I mean, you can match them with financing options and they'll take care of that, but it's not legal for, I mean, you could, but it'd be very difficult for you to check personal credits. You leave that up to the financing folks to do that because they have it set up. And it's very restricted. But on the business credit side, you can check business credit. So I had a client in my consulting business where great name, well known in the industry. Everything checked out. A friend was, knew them anyway. Long story short, I did a whole bunch of work for them, never got paid, at least 40 grand. And and when all was said and done, I realized later, once I started working with NAV, that had I checked business credit, I probably would have seen some red flags there. I'm sure
So
I
I
would have.
didn't, I never even really thought about it from that perspective. Like if you are bidding and working with other companies on projects, it could be part of your due diligence process to check and see, not just word of mouth. What are people saying? Are they getting paid or not paid? You can actually verify some of that by pouring their business credit report.
Yes, absolutely. And that may be a good measure of additional intelligence for you to decide that may affect, how much you're willing to extend before you collect payments. And I'll give you another quick Levi story because, sign manufacturing, I think there's a lot of overlap with, construction type clients. He had a chain of Mexican restaurants and the guy would always, take the longest time to pay the invoices. And Levi didn't have a lot of credit. This was rural Idaho, 25 years ago. He didn't have a lot of credit to fall back on. And so he find himself rushing to the bank to try to cash the check so he could make payroll, for his employees that day. And finally, one night he read a book and something about firing clients, and he called up the guy next day and said, "I'm done. Here's how much you owe me. You need to pay me, and I'm done. I'm not doing any more work." Well, it turns out that this owner of this chain of restaurants had burnt all his bridges before he got to Levi, and so he had no choice but to pay and then pay up front going forward because there was no one else who was willing to work with him because he had treated other companies the same way. And so that's just the kind of intelligence that may save you from a lot of financial headaches. You can't do it with your residential clients, but boy, if you're partnering with other commercial companies or maybe a subcontracting to another firm, make sure that they're financially okay and you don't see anything that stands out.
I mean, that's amazing. I think that is worth the price of admission here for today. Like that is great. Just a great way to look at it and just a different way to look at it. So this has been super educational for all of our listeners. And I thank you for that. How do you help people with this? Like I have to, you've educated us. I have to understand how is it that you help facilitate this?
Yeah, so Nav is the platform. I work with Nav, and they are a platform that lets business owners check, manage, and monitor their business and personal credit in one dashboard, and then provides tools to build financially healthy companies. So there is both a free, completely free option, and then there is a paid option called Nav Prime. And with Nav Prime, that monthly payment also not only gets detailed credit reports and other benefits, but also reports as a trade line to business credit. So that may be helpful in your business credit journey. And anybody who is like you, still sort of confused because I couldn't lay out the steps clear enough. We do have a step-by-step guide. So they can go to nav.com/ my name, Gerri, Gerri, not J, Gerri. And there they can get a free Build Business Credit checklist that will walk them through the steps, hopefully in a manner that's very clearly. And if not, they can reach out to Nav, and there's lots of folks to help them.
Awesome. So helping not only monitor, but build at the same time and then giving the resources. I absolutely love it. Is there anywhere else that our listeners could connect with you as well?
You can. I'm not super active on Instagram, but if you reach out, I'll be happy to reply. It's just my name. I do a lot of writing for the Nav blog, and I do love to hear from small business owners. So I'm just going to throw out my email address, and I really do not mind, emails from other business owners, Gerri at Gerri Detweiler, and it's kind of hard to spell, but GerriDetweiler.com. And, feel free to reach out, and I'm happy to try to share resources. That's really what I am passionate about is I've made mistakes. Like I told you, the 40 grand, and there's been others. And I'm passionate about providing resources that I hope will be helpful, which is exactly what you do on the podcast, Ron. So thank you for what you do.
Yeah, well, thank you. You have 100% done that here today for all listeners. And thank you for taking the time and being on the show today.
Oh, completely my pleasure.
Awesome. All right, construction champions, another episode in the bag. Well, we really dived into a subject that I know we have a lot of questions around. As an industry, like I said, I read it all the time online. People are inquiring about this. And not only did Gerri like give us great examples and processes, but also she gave us a different way to look at it, which really all of our listeners, especially long term, know I love different ways to look at stuff. Like we shouldn't there's always different ways to utilize tools and the information out there and to be able to help verify who you're working with. Because like she said, a lot of times you're laying out a lot of money before that 30, 60, 90-day payment is coming in. And if you have a way to be able to help protect yourself to verify, is this a company that I want to be laying out tens of thousands, hundreds of thousands of dollars, relying that they're going to pay us? I mean, we might want to check their credit. Like to me, after she said that, I was like, man, this is just like common sense. Why is this not just being screamed from the rooftops in the construction industry? Because it really just makes it so clear and makes so much sense. And if everybody was doing this to each other, it really creates a word of accountability where people would be more concerned about making sure they do pay on time, making sure the stuff is going out when it's supposed to, because it becomes that accountability piece for everybody involved. And you don't want to be like the sign guy, even like that was a mess up, but he lost an opportunity because of it. It's one of the reasons it's important to monitor this kind of stuff. Like if I went and interviewed 100 of our listeners, I bet you 90 of them would be able to tell me what their personal credit score is because we monitor it, because we don't want that bad information on there. I mean, sometimes we just have bad information on it. That's just what happens. But you don't want stuff that's an error. But then we wonder about business credit and we don't do any of the proactive stuff. So Construction Champions, go check out the checklist there if you didn't get everything off of here, and do a deep dive into this. See what you could be doing better. And I think for everybody listening that has never started with this is a great way to get started. She laid it out there for us on how to start going down this road. So don't be afraid of this. Look at it as something that long term is going to serve you, your business, your family, your employees so much better. So Construction Champions, until next time, be the champion you're meant to be.